Good afternoon, investors. We will be starting the webinar in 10 minutes. In the meantime, please invite your family and friends to join our Facebook page so that they can also watch our webinar. Good afternoon, everyone. Welcome to our webinar about growing your 100,000 pesos with smart dividend investing. I'm Franco Fernandez, DragonFi's research analyst. If you're looking to maximize your 100,000 pesos through smart dividend investing, you're in the right place. Today, we'll delve into the strategies that can help you achieve sustainable passive income and financial growth. And just a quick update for everyone. The mobile app, DragonFi 2.0 app, now allows you to watch our live by clicking the creator circle and going to our DragonFi profile. So today, joining us is Mr. John Carlo Lim, the CEO and co-founder of DragonFi, who will share valuable insights on dividend investing and smart financial strategies. Before we formally start this webinar, we are requesting that all attendees of the Zoom meeting to please mute your microphones and turn off your cameras throughout the entire session to avoid any distractions during the talk. If you have any questions, we are encouraging everyone to please comment them in the Zoom chat or in the Facebook comment section for those watching our Facebook Live. And we will answer them during the Q&A portion later. So without further ado, I'm giving the virtual floor to Sir John.
Hi, everyone. Thanks for joining us in today's passive income investing webinar. So by the end of this webinar, magkakaroon na kayo ng solid understanding of how to create a passive income portfolio with your 100K. Solid, but not in-depth. Why? Ang goal namin is to be able to convey the strategy in a very reachable manner. The problem with finance people, and I'm guilty of this as well, we couch investing terminology using deep words. And because of this, nawawalan ng interest ang people in investing, which is unfortunate because investing is one endeavor that can really change your financial future as it did mine. So if you want advanced stuff, we have a lot of articles and pre-recorded videos on our site and on our YouTube channel. Okay. Next slide, please. So the first few slides, I'll rifle through very quickly because I don't know the profile of our audience. I want to give a brief introduction. So why should you invest? We all know why. To achieve financial independence, so we can afford the life experiences and spend the time and engage with the people that truly matter to us. However, why don't we invest? So let's unpack all three. It's too risky. I don't have enough money. I don't know where to begin. Slide. So it's too risky. But in reality, if you look at this chart, the risk is in not investing. Your uninvested 50,000 pesos at an annual rate of 3%, inflation rate of 3% per annum, is only worth 27,684 at the end of in 20 years. So I grew up in the 80s and 90s, and for the young people, you might be surprised to hear that a Big Mac, a McDonald's Big Mac in the 80s cost only 25 pesos. That is the detrimental effect of inflation on your money. Worse, according to the BSP, Filipinos are not ready for retirement. Filipinos only have, on average, 3.6 months of income for retirement. And SSS only pays you an average monthly pension of 5,000 pesos. I don't have enough money. But in reality, it takes very little money to start investing. So how much will you end up with if you invest 1,000 pesos per month for over 40 years with an 8% annual rate of return? So their total contribution is 480,000. At the end of 40 years, you will achieve 3.1 million. That's 6.45x your money. That to you is the power of compounding through time. Okay, now Franco will give a brief overview on dividend-paying stocks before I elaborate on the strategy.
All right, so let's talk about dividend investing. But first, we need to understand what dividends are. So on the next slide, dividends are a portion of a company's profit that is distributed to shareholders. Now, you can determine whether or not a stock has gives out dividends by looking at its dividend policy. So the best dividend paying stocks pay dividends on a regular basis, can be on a quarterly, semi-annually, or annual basis. And the great thing about these stocks is that over time, they will increase their payouts. So that's what we want to achieve for our portfolio by acquiring as much of these quality dividend paying stocks. Next slide, please. So there are three types of securities that will earn you dividends. The first one is common stock. So these ones give you partial ownership in a company. You have the potential to benefit from capital appreciation and dividends. But when it comes to common stocks, dividends are not fixed. They're dependent on the stock you buy, the company itself, and they can vary based on the company's performance. Especially if, for example, a company's payout ratio is 50%, and if their profits drop over the course of that year, that 50% will be smaller than the one last year. So an example of some of these dividend-paying stocks are ICT, PLDT, Globe, Aboitiz Power, and there are so many more in the Philippine Stock Exchange that you can choose from. The next one is called preferred stocks. So the thing about preferred stocks is that they share characteristics with bonds. So they trade like common stocks, but they have a fixed dividend like bonds. So most preferred stocks on their IPO will give out a dividend yield between 6 to 8%. And that will, of course, change as it starts to trade. So with preferred stocks, preferred shareholders are prioritized when it comes to dividend payments. That means they will be the first ones to receive dividends, and then after whatever is left will go to the common shareholders. And now another thing about preferred stocks is that they're less volatile than common stocks. But that can also be because of one thing, preferred stocks don't trade as active as common stocks. So that's why it seems less volatile. A lot of these publicly listed companies like SM, Ayala, and San Miguel Corporation give out preferred stocks. So I think San Miguel Corporation has the most number of publicly listed preferred stock in the stock exchange right now. It goes all the way to, I think, SMC 2O or N. Yeah, you can check it out yourselves on our mobile app. And the last one is called real estate investment trusts, or REIT for short. So these are companies that own income-generating properties. They invest in the real estate industry. You can invest in the real estate industry without the need of purchasing a land yourself or a building. So it's a great way to get exposed to the property sector in the Philippines, because one, you don't need a lot of capital to invest in a REIT. I think you can even get started with less than 1,000 pesos. I think one of those REITs is, for example, RCR, where the board lot is only 100, while the price is around 5 pesos. It's managed by experienced professionals, so you don't have to worry about anything regards to property management. And the best thing about a REIT is that they pay out at least 90% of their distributable or taxable income as dividends to shareholders. So every year, you can expect to receive dividends.
So I want to say a little bit something about REITs. So, diba, we all want to be landlords to rent out a property. Here's the problem. With today's real estate prices, sobrang baba na ng yield. So what's a yield? Yield is your return based on the value of your property. So example, you have a house, pinarent out mo for 1 million pesos a year, and your house is worth 10 million pesos, the yield is 10%. So now I have friends who rent out houses in exclusive villages, and they pay only 1 to 2% of the value of the property in annual rent. So later on, you will see that in REITs, like a REIT, which is managed, whose sponsor is Ayala Land, you can get 6.34% from the rental income of the malls such as Glorieta and Greenbelt. Isn't that a tantalizing idea? Yeah, go ahead, Franco.
All right. So going back, so when it comes to dividends, there are 3 important dates that every investor should always know about. The first one is the X date. So this is the date when shareholders are no longer qualified to receive the dividend. The next is the record date. It's always a day after the X date. It's the specific date on which the company finalizes the list of shareholders who are eligible to receive their dividends. And the last one is the payment date. That's when you will be receiving your dividends. So here's a quick example of what that will look like. So for example, on July 1, you own the stock. So as long as you hold it on you buy it and hold it on July 1, you are eligible to receive the dividends by July 12. But if you buy the stock on July 2, you are no longer eligible. But you can, in fact, sell your shares on July 2 and still be eligible for the dividends.
So these terminologies, X date, record date, payment date, may be new to a lot of, let's say, people who are just starting off on their investment journey. But don't worry, we explain this very well in the Investing Club and in other material content in DragonFi. So, okay, now how should we invest? Now we get to the part on how to best compound your money. So the key here is, as Franco mentioned, is to invest in dividend-paying stock. The strategy that we espouse is called the dividend harvest strategy. Essentially, you establish, nurture, and harvest a stream of income, dividend income. So pinapalaki mo lang ng pinapalaki yung dividends mo. You shift your attention away from stock price and capital gains. And the focus is on the dividend stream, the size, safety, and growth. So every market has a different way to maximize profit. Example, in the US over the past 30 years, growth and momentum investing has been the most profitable way to play the market. In crypto, it's more technical and supply-demand oriented. For the Philippine market, the best way to play it is by way of dividend stocks. Why? Because the Philippine stock market is comprised of oligopolies and monopolies, which is important for both dividend safety and growth. Also, because the Philippines is an emerging market, investors demand tangible returns in the form of dividends, something that you can touch and feel, i.e. cash. So here's a visual representation. So here in this picture, ang goal mo lang, as I said, pinapalaki mo lang ng pinapalaki yung dividends that you get paid. Of course, you have to buy the stocks at the right price. And you can learn about those sa mga contents namin sa site. And if you join the Investing Club, that I will elaborate on later. So if you see in this picture, lahat ng dividends coming from dividend value stocks, REITs, preferred stocks, and dividend growth stocks, you're just increasing and increasing and increasing. Why is this a great strategy? So imagine mo, let's say, you're lucky enough that by the time you retire at 65 years old, you have 10 million pesos. And you estimate that you will live on until you're 85. So for the next 20 years, your goal is to sell 500,000 pesos worth of stock to fund your lifestyle. Okay, what if nagkaroon ng recession yung Philippines and the global economy humina and the market corrects by 20%? So instead of 10 million, you only have 8 million. And now you can only sell 400,000 pesos worth of stock every given year to fund your lifestyle. But if instead you focus on the dividend stream, as I said, its size, its growth, its safety, then you don't care about the day-to-day fluctuation of the stock. Again, this is also predicated on the fact that you have to buy the stocks correctly at the right price. And that's what we teach here in the Investing Club. Okay, so again, another way to help you visualize, I'll tell you the story of ICT because it's the gold standard. And this is what we're trying to find in the market on a daily basis. So ICT in 2002 was only worth 3 pesos and 19 cents. On that particular year, it paid 30 cents in dividends. So let's say, for example, you bought 100,000 shares of ICT in 2002 worth 319,000 pesos. That year, you would have received 30,000 pesos in dividends. The great thing about ICT is that it has a dividend policy wherein it states that it will never pay a lower dividend than it did the previous year. So ICT increased its dividend at an annual growth rate of 23.4%. 23.4% over the next 20 years. So by the time in 2000 in April of 2024, instead of paying you 30 cents a share, ICT actually paid you 9.35 cents, 9 pesos and 35 cents. So now, instead of getting paid 30,000 pesos, you got paid 935,000 pesos. So there's, as I keep on telling people, there's only one stock in the entire S&P 500 in the US that beats ICT's performance over this same time span, and that's Apple. Okay, next slide. Okay, so how do you find the best dividend paying stocks? Whenever you buy a dividend paying stock, you always ask yourself three things. Is it safe? Is it growing? And what's the return? So is it safe? So this is going to be on a very high level. We didn't want to make it too technical that we lose the people who are just starting out. So on a very high, so is it safe? There are metrics such as the payout ratio. So payout ratio, Franco alluded to this earlier. Payout ratio is the percentage of the company's earnings that it pays out in dividends on a given year. Let's say, for example, the company earns 100,000 pesos this year. It has a payout ratio of 60%. It has a payout ratio of 60%. So the company pays 60,000 pesos worth of dividends. So that essentially is the payout ratio. You don't ever want the payout ratio to be too high, because if it's too high, that means it's not sustainable. Why? Because that means it's not reinvesting in growth initiatives within the company. You don't want it too low, because then you're not getting the meat of the company's earnings. So return on equity just simply measures like the effectivity of how a company generates profits relative to capital invested. Historically, it is hard for companies to maintain a high return on equity. But if you're a monopoly and you're an oligopoly, like for example, Banco de Oro, BPI, SM, Ayala Land, if you're a monopoly and an oligopoly, you tend to have very high return on equities over a long period of time. This is what I alluded to earlier, why the dividend strategy is the right way to play the Philippine market, because we are filled with oligopolies and monopolies. Debt to equity ratio just measures the leverage. You don't want a company that's too indebted, that it has a lot of debt in the balance sheet. So debt always increases the volatility of earnings, especially during bad times. When during the bad times, if it's paying out a lot in interest payment, so the company can become insolvent. So you don't want to have a lot of, the debt to equity to be too high. Interest coverage ratio is the operating the multiple of debt is basically operating income divided by interest expense. So you want to have a high multiple that identifies the fact that the company can easily service its debt. Okay, next slide. So again, as I said, is it safe? The next question is it growing? So to determine this, you look at the company's dividend history. So if the company is a company that keeps on paying higher and higher dividends, the same as the ICT story that I mentioned earlier. And ICT is not alone. You also have companies such as Meralco that pays higher and higher dividends, and lately AREIT, as a matter of fact. So you want the earnings estimate and guidance to be higher and higher each year, because usually when a company has a dividend policy, it's usually a percentage of net income. And if you have higher net income, then the company will pay higher dividends. Lastly, what's the return? So this is what I was saying about paying the right price for the stock, para meron kang margin of safety. You can't just keep on chasing a stock, right? You want to find the stock's dividend floor, which we will explain in another time. We want to find a stock's dividend floor. And when it's at the dividend floor, let's say, for example, the dividend floor is a 7% yield, then if you determine that the stock will keep on growing its dividends over time, then that's when you should be buying a stock, because what you saw in ICT, something that I forgot to mention, it is dividend growth that supports higher stock prices. So I mentioned that ICT's dividends increased from 30 cents to 9.35, 9 pesos and 35 cents in by 2024. What I forgot to mention is that ICT's price went from 3.17 pesos to 300, now around 350, 360 pesos. So how did this happen? Why did this happen? So imagine, let's say ICT paid 10% dividends at that price, around 10%, 30 cents over the 3.17 pesos. What if next year ICT commits to pay a higher dividend? If it pays a higher dividend, let's say it pays 20% more dividends, then the stock price can also go up by around 20% without affecting the dividend yield. So that's why what I mean by when I said dividend growth is what supports higher stock prices. So we compute, by the way, don't worry, we compute all this for you in the investing club, and all the metrics that we mentioned earlier to determine dividend safety, dividend growth, and margin of safety. We have what you call the dividend screener. It's available in both the mobile app and in the web, and in our web. So you can easily spot the right stock with the right dividend profile characteristic. Okay, now here comes the part that you tell me, but lahat to theory lang eh. There's what's the evidence about? What's the evidence? In DragonFi, we have what we call the investing club, where we manage a real money model portfolio. So we started this last November 29. So as an account holder, you get trade alerts before we buy and sell anything. So you can learn how to create your own passive income portfolio. We explain the logic and the rationale behind each purchase and each sale, in each sale. So again, it's a learning tool for the community. In DragonFi, we're obsessed about building a supportive community of fellow investors that support one another in our respective investment journey. So Franco will discuss the performance of the portfolio.
Yeah, all right. Thank you, Sir John. All right, so let's see our portfolio in action. So as of today, as of market close, the total return of our portfolio is actually 17.8%, which already outperformed the index by a significant margin, because from our inception date of November 29 to today, the index only has a return of 2%, and year to date, its return is actually negative 0.92%. So by this, we can already see that dividend investing really does have an impact, especially despite especially when the market is down. So right now we have 7 stocks. We have A-REIT, PLDT, Mineral Water, C-REIT, RCR, Globe, and Aboitiz Power. So these stocks were all bought throughout the span of
November 30.
from November to June. So about 8 months. So far, we have earned a gross amount of 2,767 pesos in dividends, and we also made a deposit recently of 9,000 pesos. So we've deployed most of our capital already, and as we move on, as we find more opportunities, we will the investor club will be made aware of any future deposits. So if you do want to keep track of our portfolio, please follow our investing club and check out our model portfolio updates. On the next slide, we'll be breaking down some of our best trade alerts, our best trades. So starting with Mineral Water. So our trade alerts, in case you want to know more detail about this, you can simply go to the DragonFi Investing Club and click on Trade Alerts. So as mentioned earlier by Sir John, we go through each of the questions. Is it safe? Is it growing? And what's the return? So on the left side, we've answered the first 2 questions. Is it safe and is it growing? And with regards to what's the return, when we decided the maximum price based on the Gordon growth model, we came to a required rate of return of around 11%. and that gave us a maximum price of 20 pesos, 20.05 pesos. So going into more detail on this trade, we projected that Manila Water would be paying a dividend between 1.10 to 1.15 pesos. And we're very close because the actual one was 1.13 pesos per share. So we were able, at the current price, we were able to lock in a dividend yield of around 6%. So in February of this year, we bought 400 shares at 18.84 pesos and another 400 at 18.94 pesos. So as mentioned earlier, if you want to know more about how we broke this trade down, please look at our trade alert in the Investing Club. So on the next, we'll show you the chart. So as of today, as of yesterday, as of June 26, our position is actually up 48%, and that's excluding the dividends we earned. And then another example of our portfolio, another example is, next slide, A-REIT, I believe, yes. So with A-REIT, we bought it 3 times, November 29, December 1, and May 24. Our average price is around 30 pesos. And right now, our position is up 13.51 peso, 13.51% as of yesterday. And finally, Globe, where we bought it on May 6 at around 1,770 pesos. As of yesterday, it was up 15%, but today, after today's close, I believe we're already up 18%. So we understand that not everyone would be able to follow our Investing Club model portfolio from the inception date of November 29, and that topping up is another factor to consider when you want to grow your dividend portfolio. So with that, we created the buy ranges for Investing Club stock universe. So we actually posted this a week ago. It's an article in our Investing Club. So using the garden growth model and based on our estimates and forecasts, we were able to determine a couple of buy zones for all of our stocks and bullpen. So right now, as you can see from the green highlights, we have 3 stocks that are still within the buyable ranges or buy zones that will give you good dividend yields from 6 to 7%, 6 to above 7%, which is really good. It's because before when we talked about dividend investing, the sweet spot is usually between 4 to 7%. So that's the target you always want to aim for. So let's imagine that you bought these stocks today. So on the next slide, it would following the buy ranges, we would arrive at 400 shares for A-REIT, 5,000 shares for C-REIT, and 400 shares for Aboitiz Power for around 13,000 pesos each. So since we have 7 stocks, we divided 100,000 pesos by 7, which would allot a maximum allocation per stock of 14.3%. And that would lock in an annualized dividend yield from 6.51% to 7.13%. So it's not too late to start following our dividend portfolio, although for the other remaining stocks, for the remaining 4, it would take time before that these stocks become viable again. Because once again, we don't want to chase any of these stocks and jeopardize the yield of our portfolio. So let's say you invested 100,000 over the course of the next 20 years, and you contribute at least 20,000 pesos every year with a required rate of return of 9%. Why 9%? For this example, because the CAGR of the PSEI over the course of 20 years is somewhere between 8 to 9%. And but of course, you can always, if you want to outperform the index, you can always give yourself a margin of safety. So by the 20th year, you would have a portfolio value of 1.58 million after contributing a total of 400,000 pesos. And by the 21st year, with a dividend estimated dividend yield of 6%, you would actually be earning almost 100,000 every year in dividends. So you'd be earning back your initial investment. You'll be earning almost your initial investment after every year after the 20th year. Yeah.
So thank you, Franco. So that gives you guys a great idea on how to craft your portfolio. Let's say if you're starting your investment journey today. And these are all hypothetical numbers. You don't need to invest 100,000. You don't need to top up by 20,000. You can customize it to your unique financial situation. So remember earlier, I gave you guys 3 reasons why people don't invest. It's too risky. I don't have enough money. And the third one is I don't know where to begin. And out of all the 3 reasons, this is actually the most valid one. And in DragonFi, we understand this. So we layered in tools and learning resources to fill the knowledge gap. Next slide, please. So in addition, we designed DragonFi, like I mentioned earlier, to be an inclusive community of fellow investors, helping one. So last December, as we mentioned, we started the investing club. So this is what it looks like in our app. So when you follow the DragonFi research team, as we manage and grow a passive income portfolio, you get trade alerts before we buy and sell anything, analysis and research, and a ton of education to help you become a better investor. Also, we have what you call the DragonFi roadmap. So you can learn everything you need to know about technical analysis, fundamental analysis, and investing. We doubled down on the community aspect recently around April when we created the Creator Circle. So the Creator Circle are comprised of the best and most popular financial literacy creators in the country. So we host their content on our app, so you can learn not only from us but from others as well. And a lot of these guys actually they post their portfolios for everyone to see on their YouTube channel, which you can conveniently access through our mobile app. For a more personalized touch, we started the Goal Getter program, where investors can book a calendar with me and our research team so we can help people get started on their investment journey. I think, Claude, we can share the link of the calendar so that people can book just in case they're interested. Even if you're not a client right now, you can book so that you can get a feel for what we offer here in DragonFi. So DragonFi is the only brokerage in the country. So let me just cite a few things that make us different. So DragonFi is easily the most tech-enabled brokerage in the country. So our technology is actually underpinned by the technology. We share the same technology as the largest brokerage firm in the US. We're the only broker in the Philippines approved for eKYC. Just like the banks, you can do your selfie, liveness check, and upload your government ID. And you can start by doing so. You can open an account and start trading in as little as 15 minutes. So here you go. Those are the QR codes. Feel free to download DragonFi Mobile 2.0, and we now open the floor to your questions.
All right, thank you, Sir John, for that. So yes, let's get started with the Q&A. Please send in your questions and we'll do our best to answer all of them. All right, so let's have the first question. How do I compute for the dividend yield?
Okay, Franco, I think you can take
Okay,
it.
all right. So to compute for the dividend yield, it's simply the annual dividend per share over the current market price. And that will give you a percentage. Yeah, and that's the dividend yield.
Yep.
All right, next question. If you say don't focus on the price, does it mean I could just add volume without having to consider the price each time I buy additional shares?
No, that's not what we mean. As a matter of fact, if you recall, I mentioned that you should always buy at the correct price, and we actually calculate this for you using the viable buy ranges. So we calculate it using the most popular valuation model for dividend paying stocks, which is the Gordon Growth model, or whether it's a single stage or 2-stage or 3-stage DDM. So from there, what I meant to say is that if you focus on always buying the stocks at the margin of safety, then your next focus is simply to just grow and grow the dividend stream without focusing on the day-to-day fluctuation of the stock. So as for the you're probably going to ask me the risk management aspect. The time that we sell a stock is when if it's dividend, either it's dividend safety or its dividend growth is compromised by way of fundamentals that are deteriorating. So in situations like this, that's when you decide to make a portfolio management decision whether to liquidate a particular stock. But it doesn't mean that you don't pay attention anymore to the price that you pay for the stock. You actually have to always pay for the stock at the right price.
All right, thank you, Sir John. Let's have the next question. Where can we find information about a specific company's dividend policy? Is that information available during a stock's IPO? I think I can answer this.
Yep.
So you can easily find a company's dividend policy by one, looking at their annual report or searching through their company website. So for example, you can just simply Google search, for example, ICTSI dividend policy, and it should pop up. And as for the IPO, yes, you can find the dividend policy of a stock in its prospectus. For example, NextGen, an IPO that's coming out this July, it has a dividend policy of 10 to 30%. So you can find that in their prospectus. All right, let's have the next question. Paano makuha ang dividends? May note if you can get the dividends or auto payout na my balance sheet need po kasi for final tax. Planning to move my assets in DragonFi.
Yeah. So yes, you get notified via email every time you receive. And actually, so let me show you. I hope you guys can. I hope you can see this. So this is the DragonFi app. This is the DragonFi app. If you click dividend history, let me check right now. So if you click dividend history, you'll see there the dividends that you receive. And if you click upcoming, you will see there the upcoming dividends that will accrue to your account. So as far as the final tax is concerned, typically it's already, if you're a Filipino resident, right? If you're not a corporation or if you're not a foreigner residing in the Philippines, it's already, the 10% withholding tax is already deducted.
All right. Thank you for that awesome question.
Yep, great
Let's
question.
have the next one. What would be a good payout ratio?
All right, this is another great question. The answer, as with everything in life, it depends. Why? Because different industries have different unit economics. Example, let's say the REITs. The REITs, they're mandated to pay 90% of their taxable income on any given year. So, but some other industries cannot support that level of dividend payment, right? But others can. Like for example, if you look at ICT, even though they're actually very highly leveraged. So again, we're talking about, right, dividend safety, dividend growth, and margin of safety. If you look at ICT, their interest coverage ratio is actually not that high, but because of the stability of returns, so this is the point I'm trying to make. If that particular company or industry has a stability of returns and has the very visible recurring free cash flow that comes into the company, then it can support a higher payout ratio. So it really depends, but you don't want the payout ratio typically you don't want it exceeding 70%.
All right. Before we go to the next question, I just want to encourage everyone again to send in any questions they have about dividend investing and we will answer them.
Yeah.
Okay, so the next question is, where and how can I buy dividend paying stocks or REITs in the global market so that I will be paid with dividends?
Global markets, but by that you mean outside the Philippine Stock Exchange?
I think that's what this person means.
Okay. All right. So there's two ways. So A, you open a US brokerage account. So so that's going to be a foreign company. You open a US brokerage account and you can buy the REITs that are available in the different markets overseas. B, there are actually REITs and dividend funds by the different fund companies. I believe we have one with Manulife, if I'm not mistaken.
Yes, that's correct.
Yep. So you can actually get exposure to REITs and other dividend paying stocks by way of funds as well, by UITFs, which you can also, by the way, purchase directly from the DragonFi app. I'm going to show you guys again. So this is the DragonFi app. You can, if you go to funds, you can purchase the funds directly from your app.
All right. The next question is, aside from the dividend history of the dividend yield, what are the other equally important metrics to say a company is growing?
Okay, you wanna take that, Franco?
Okay, sure. So another way to check if the company is growing is to, well, one, to check their EPS, their earnings per share, and based on that, you'll be able to tell if their dividend will be growing, because usually if they have a dividend policy, it's always based on the previous year's net income, and EPS is based on that. So, for example, if an EPS grows, if a stock has 50%, a 50% payout ratio as its dividend policy, and its EPS from 1 peso to it grows to 2 pesos, you can expect that from a dividend amount of 1 peso, 0.5 pesos per share, it will grow to 1 peso per share. So that's one way to check. Another way to check is, I believe, by looking at one guidance, if the company projects that due to higher sales, for example, or higher rates for electricity or energy, that they will be able to generate more income and hence increase their dividend per share.
Yep. Actually, so basically what Franco is saying, it's the typical metrics of revenue and earnings, right?
Yeah.
But you always want to ascertain what people refer to as the quality of earnings. Let's say, for example, the earnings are growing, but it's because of cost cutting as opposed to growing revenue. Then you have a potential red flag. Then you have to dig under the surface to find out.
Thank you, Sir John, for adding.
Okay.
Ang ICT po ba is monthly dividend sharing? I can answer this. So ICT does have distribute dividends annually, but historically, it's always accompanied by a special dividend so far. So it would have a regular dividend, and at the same time, it will also distribute a special dividend. But officially, on its dividend policy, it's an annual dividend distribution.
So different company, different dividend calendar. Some companies distribute every quarter. Some companies distribute semi-annually. Some companies, let's say, for example, like Avoitis Power, they distribute annual dividends. Yep.
All right, let's go to the next question. Is there a functionality in DragonFi platform where dividends are automatically reinvested?
Yeah, this is a great point. We'll look into this. Okay. One good development about that's happening in the PSE is by next year, the PSE is going to be rationalizing lot sizes wherein you can buy for as little as 100 pesos. Why is this important? Because it's going to enable us to incorporate functionalities as the one that you suggest. Because right now, let's say, for example, if we automate the dividend reinvesting process, but the dividends that you receive actually is not enough to cover for the minimum lot size of the stock, then it's going to be quite difficult to execute something like this. But it's easy for us. If you've noticed, if you go to the DragonFi platform, you will see that no broker in the country has ever innovated this quickly and this fast. As a matter of fact, I'd like to encourage people to tune in the next couple of months. We're going to release several innovations that actually Filipino investors have not seen.
All right, cool. Okay, let's go to the next question. Do you have an updated list of the dividend titans and champs with an analysis of their performance after 2019? Do you have a recommended buy zone for them? Thank you. Okay, wow, that's actually great that you remembered the dividend titans and champs that we haven't talked about in a couple of months already. But yes, we can update the list. So far, we've been very focused on the dividend harvest strategy and among other things. But based on just observation alone and the latest trends in the latest dividend distributions, the list of dividend titans and champs will most likely stay consistent.
Yeah.
Because if we go back, if it's from 2019, then yes, it will be the same. Probably, it's almost certain that the list will be the same. So I think you have ICT, you have Ayala Corporation or Ayala Land, and you have Jollibee, for example. For the buy zones, yes, we can make them. It will definitely be based on the Gordon growth model just to stay consistent. So yeah, we will we will update the list.
Yep. Franco pointed out something very important there. Usually, not just here in the Philippines, but in let's say, for example, in the US, once you're part of that list, these companies are incentivized to stay on the list, because usually there's a material breakdown in the price of a stock in the event that they actually break the trend. So that's why it's very important to track the historical dividend declaration and distribution of these stocks. So again, I'm sorry, I wish we prepared for this, that we can share the app and the tools. Again, if you look at the app, you'll notice there in the dividend screener, we actually list down the 5-year, 10-year, and 15-year compounded annual growth rate in the dividends. So this is a very handy tool. You can use this. For example, you can see here that there's I'm not sure if it's clear to you guys. There's the debt to equity ratio, interest coverage, and whatnot. So you can determine the safety, growth, and margin safety of the dividends.
Yeah. All right. Thank you, Sir John.
Yep.
Let's go on to the next question. Why don't we have preferred shares in the model portfolio?
Okay. I can take this, Franco.
All right.
All right. So I'm not sure if you recall what I said earlier, wherein it's dividend growth that actually supports higher stock prices. So what I try to find are stocks that will continue to grow their dividends. The issue that I have with preferred shares, although because of the high interest rate environment, the high cost of capital, the preferred shares have been giving out pretty decent and actually very high yields, right? But what I'm looking for long term is like what I mentioned earlier. I want to keep growing the stream of dividends that investor will receive. So let's say 10 to 15 to 20 years out, your dividend stream is getting bigger and bigger and bigger. That's not possible with typically that's not possible with preferred shares because they have a fixed dividend rate. Yeah.
All right. Let's go on to the next question. How about mutual funds that give out dividends like the PhilAm Strategic Growth Fund?
Yep. There's absolutely nothing wrong. Absolutely nothing wrong with funds, although you should always take into account that with funds, you have to deal with the sometimes high expense ratio of the funds. So typically, there's a trust fee and an additional fee. Although it's stated there that they don't charge you a fee, but if you look into the prospectus, there's actually a trust fee and some level of management fee, especially if it's a feeder fund tied to other funds.
All right. Let's go to the next question. What are the qualities to be able to tag as preferred stock and common stock?
You want to take that?
If I understand this correctly, this is I think trying to determine whether a stock is preferred or common. So with that, actually the best way to determine if a stock is preferred or common is looking at its profile, a stock profile. So it will always be tagged as common or preferred stock. So on our dividend screener, you can actually look at the complete list of all dividend paying stocks and preferred stocks. So you can sort them out by common and preferred stocks. So you'll always be sure whether or not you're investing in a common stock or preferred stock.
Yeah.
All right. Before we go to the next question, if you have more questions, please send them in. We still have time to answer more. Next question, please. Can you name some of the good candidates for preferred stock investing? I guess right off the top of my head, I believe if you bought, I think ASIN B, the dividend yield of that was 8%. So that is much higher than the Philippine 10-year bond, which gives you 7%. So if ASIN B still trades at 1,000 pesos per share, then you would be able to lock in that 8% dividend yield.
Yeah.
But there are a lot of other good dividend yields. Preferred stock, sorry, worth investing. I believe like San Miguel's preferred stock.
Yeah.
Some of them, most of them give good dividend yields. It's up to you to determine whether or not those yields are right for you. So it does entail looking into those individually. Yeah. So yeah, ASEN, San Miguel Corporation are some of the, I believe, are good preferred stocks. Yeah. Let's go to the next question. Aside from Philippine stocks, what markets and funds are available in DragonFi?
So right now, for direct stock investing, it's only the Philippine market. We actually do hope to offer the US markets one day, but unfortunately, no local company is currently allowed by the SEC to offer US stocks. But we are continually discussing this with the SEC. Hopefully, one day it will be made available to Filipino investors, because that's really a different profile that I'd love to offer to Filipino investors. Right. Funds, by the way. So right now, for the funds, you can access, like, for example, we have the Manulife Global Tech Fund, which invests in all the generative AI stuff that you're probably familiar with.
All right, thank you, Sir John. Let's go on to the next question. Will DragonFi ever come up with a fund similar to SCHD, sort of like an ETF that mirrors the model portfolio?
Yeah. So the Philippine Stock Exchange is actually, they have a draft of a proposal to change the ETF rules, because right now, if you notice, let's say there's an ETF, the First Metro ETF, but it's very illiquid. And the reason for that are on account of the market dynamics and the restrictions put forth by the SEC. I recently spoke with PSE management, and they have a proposal to lower the guidelines and rules surrounding an ETF provider, and we are actually definitely interested. You guys are actually reading my mind.
All right, that's awesome.
Yeah.
Okay, let's go to the next question. For newbies, I really don't know about the terminologies. Which good investment to start with, funds or stocks?
Okay. Well, usually what you hear from people is that they usually get started by way of funds, because they're actually not familiar. But you know what? To be honest, nothing really beats direct stock investing. If you'd like, please reach out. Email me at John, so John without an H, at dragonfi.ph. We can set up a Zoom call, because as I mentioned earlier, we have the Goal Getter program, so that I can activate you to the basics stock investing. it's really a worthwhile endeavor.
All right. Let's go to the next question. Where can we find the viable price ranges? Tried to look for it in the Investing Club page, but couldn't find it. So actually, it is in the Investing Club page. So once you go there, you click on Analysis and Research, and under Recent Articles, you will find an article titled "REIT and Investing Club Buy Ranges."
Yep.
Yeah.
Here
So-
you go. REIT and Investing Club Buy Ranges.
Yeah, there you go. Thank you, Sir John.
You're welcome.
Okay, so let's go to the next question. Is NextGen a dividend stock or growth stock? So, okay, I can answer this. So NextGen is actually can be considered a growth stock because part of its plan, and the reason why it's IPOing is because it wants to expand its portfolio with new solar and wind projects. So it's raising capital to do that. And the low dividend policy of 10 to 30% means that it's reinvesting majority of its earnings into its business. Hence, it's a growth stock. Yeah. Thank you for that question.
Yeah,
Hope
good
you
question.
maybe you might consider investing in NextGen over the long term. But anyway, let's go to the next question. Can you please elaborate on the debt to equity ratio? If we compare telcos to other sectors, they're highly leveraged.
Correct. So there are industries like I mentioned, like for example, ICT as a port operator, telcos, and other utilities. Let's say potentially Manila Water would also have probably a high debt to equity ratio. The reason for this is it's a very what you call a capex heavy, right? Capex heavy industry. This is precisely why I mentioned earlier that it usually comparing one stock to another in a different industry is comparing apples to oranges. So the way you should really look at it when you analyze it, aside from you do your common size statements, right? Common size statement means you get an aggregate of all the ratios and make them a percentage value. But apart from comparing all those ratios to one another, you actually have to it's best to compare each stock to its industry peers. That way you get a better sense of whether let's say for example its leverage ratio is actually high or not, because it really depends on the industry. Because some industries, like for example ICT or Manila Water, there's really a very visible recurring income that's why they can afford to have higher leverage ratios.
All right. Thank you, Sir John, for that explanation.
You're welcome.
All right, let's go to the next question. What is a good ratio between stocks and funds in terms of allocation for moderate risk profile?
Well, in my view, it's not really a matter of, let's say, allocating between stocks and funds that change your risk profile. It's more of, let's say, the mix of different asset classes. Let's say, for example, let's say if you have a more moderate stance, right? You want to mix your equity portfolio with, for example, a bond portfolio or other fixed income portfolio, such as a money market portfolio that really reduces the standard deviation of the entire portfolio. So that it pertains more to investing in different asset classes as opposed to between, let's say, a stock fund and direct stock exposure.
All right. Thank you. Let's go to the next question. What are Manulife funds na dividend paying? So there are actually five UITFs that pay dividends from Manulife. An example of this is the Asia Pacific REIT, the Global Preferred Income Fund, and the Global REIT Fund. So if you go to our fund page, you can view these funds yourself and check out their payout, the frequency of their payouts, the current NAV, and the return, and what they invest in.
Actually, this is a very timely question. So I'm always continually searching for different viable investments. And I actually met with a fund provider a while ago that I saw had one of the best dividend fund paying fund profile that I've seen among the different competitors. And I'm hoping to launch that particular fund soon within DragonFi.
All right, awesome. Let's go to the next question. If I have 100K now, how many stocks should I buy?
I would, Franco, would you like to opine? It can range.
Yeah, it really depends, but we're actually gonna have an article on this. There, ideally, with 100K, you can aim from 5 to 10 stocks. Because you wanna invest in meaningful positions to ensure that you can reap the maximum amount of return that your investment can make. So you don't want to have like 20 stocks worth total value for 100K, because your position sizing would be so small and you wouldn't really benefit from the return won't be maximized, especially if, for example, you're spread out across a wide variety of stocks that that vary in returns. So what you want to do is you want to focus on these good quality dividend paying stocks. And hence, if you have smaller capital, you really want to concentrate them on the winners rather than buying a lot of stocks while you have at least 100K. Once you go up to, let's say, like 500K, you can start increasing to like maybe 15 to 20 stocks already.
I actually talked about this yesterday during the Investing Club huddle. So we studied this in, so I did my MBA in the University of Chicago. So we studied this quite a bit. There's really a point wherein you're over diversifying. As I mentioned yesterday, beyond the 19th stock, you're no longer really paid for diversifying. So the standard deviation of your portfolio between the 19th and 1000 stock only rises by around 2%. So you want to keep it. If I were a retail, as a retail investor, I'd like to keep my stock portfolio within the 10 to 15 range. So for 100,000 peso portfolio, you can actually buy around 5 stocks. I'd start with a starter portfolio of 5 stocks.
All right, awesome.
Yeah.
Let's have the next question. Oh, when will DragonFi offer US stocks, Sir John?
I hope somebody from the SEC is listening to this webinar. I've been knocking on your door month after month after month. As you can see, there's really a lot of Filipino investors really interested in getting US stock exposure. To be honest, if it were up to us, as I mentioned, so I mentioned earlier that the back end of DragonFi, actually, we share the same technology as the largest brokerage in the US. And the reason we made that investment is actually we wanted to offer US stocks, Philippine stocks, and other asset classes on day one. I'm just hoping that, I'm always going, I'm never going to stop trying. And I know other companies are trying as well. I was actually proposing an industry-wide lobbying effort with the SEC. I'm hoping that one day they would listen, because it's really unfair. There's really, okay, this is just my opinion. There's really a mismatch in terms of message and intent. If you take for granted that Bitcoin and Ethereum are legitimate investments, but there are coins such as MuCoin, Dogecoin, and you're not afraid to offer those to the Filipino investing public, but you don't want to offer Microsoft, Google, Nvidia, and the like, Apple, to the Filipino investor. And what message are we saying? Wherein very wealthy individuals who have private banking accounts can have direct access to the US market, wherein the mass affluent and middle class who actually need the ability to compound their investments faster. What does it say? What does it say? Sorry, I'm very passionate about this because I've been trying and trying and trying. And I hope one day, if anybody within the audience is very influential with the the administration or the SEC, I'd appreciate your help.
All right. Yeah, I also hope that we'll have US
Yeah.
stocks one day. All right, let's go to the next question. Do you suggest peso cost average? I believe you answered this question during your investing club huddle, sir.
Yes. Okay. So I have a real aversion to, peso cost averaging works. Let's say, for example, let's say you buy a particular stock today, let's say a REIT. Then 2 months later, 3 months later, it's still within the viable buy range. Okay, that's fine. That's fine. You can peso cost average. But peso cost averaging has its limits, because you cannot tell me that let's say if you bought a stock at 10 pesos, the stock doubles to 20, the PE multiple, let's say, rises from 30 to 60, that you can still do peso cost averaging. That's not intelligent way to pay. The way to play it, whether in the US. So by the way, I trade both US and the Philippines. The way to play is to always have that margin of safety, to buy it at the correct buy point, and not to just peso cost average. So peso cost averaging is really an abuse financial concept by a lot of brokerage firms, especially here in the Philippines. They're actually just co-opting what they keep on hearing from, let's say, the US, wherein they always say just dollar cost average into the SPDR or into the VU, which is the Vanguard S&P 500 ETF, wherein you're just dollar cost averaging on the premise that according to the most recent data, that the US market goes up 82% of the time. But if you take a look at the Philippine market, I did a study on this. If you take a look at the PSEI does not go up 82% of the time. It goes up only 60% of the time ever since the PSEI was constituted. So 60% is above 50%, so it's not bad. But again, even if you say those things, even if you say 82%, even if you tell me it's a 90%, these are data mining biases and backward-looking data. What if, let's say, for example, the US with that immaculate 82% hit ratio suddenly encounters stagflation similar to what happened to Japan, and then the market treads sideways for 30 years. As a matter of fact, the Philippine market has treaded sideways for 10 years, right? So see, if those circumstances happen, then all those stats go out the window. So instead of peso cost averaging, what you should do is always continually buy right. The largest brokerage firm in this country, they actually espouse peso cost averaging. But I was actually in that room when that was being discussed. In reality, the people internally don't believe in peso cost averaging, but they're pushing peso cost averaging because why? It increases commissions.
All right. Thank you for that amazing answer, Sir John. Let's go to the next question. Do we need to cut losses if there are cases of a crisis? What strategy do you suggest in this kind of events?
Yes. The answer here is yes. Remember, I mentioned earlier, the time that you liquidate stocks is when dividend safety and dividend growth are compromised. So I've actually experienced a few crises in my 24 years of investing, and every time there's systemic risks, and you could really spot it with enough time to react. If there are systemic risks in the economy and in markets, for example, the great financial recession of 2008, wherein basically the S&P 500 was cut in half. So those are the times that you liquidate. You liquidate as a defensive position, and you shoot first and then you ask questions later. Those are the things that I've seen throughout my life. I've experienced the dot-com bust of 2001. I've experienced the great financial recession. And the most recent one was the COVID crisis, where even though it quickly bounced back after a major sell-off, there was still that a sell-off that you could have really protected yourself from.
All right. Thank you, Sir John. Let's go to the next question. Oh, I don't think this is a question. I am loving DragonFi, looking forward to provide fractional shares on our local market. I am now sharing this app to my friends. Good job.
Thank you so much.
Yeah.
But I'd like to really actually elaborate on fractional shares. In reality, what the PSC is proposing for next year, wherein you have the 100 peso lot sizes, I actually that is enough. The reason fractional shares cannot exist in the Philippines is behind the scenes. If you have fractional shares, you have to have a market making function behind the scene, meaning there is somebody taking inventory of this stock. Let's say, for example, somebody has to buy, let's say somebody has to buy one share of a particular stock. Let's say one share. And that one share, he has to break it down to, let's say, a tenth, a tenth, a tenth, a tenth, a tenth, a tenth. But out of the one share, let's say only 6 people actually invest in 6/10 of that one share. That person, that market maker, is on the hook for the remaining 4/10 of that one share. So that's why fractional trading can't truly exist. I mean, it can, but it will come at a significant cost and not with the liquidity issues of the Philippines. I think what the PSC is proposing about 100 peso lot sizes is good enough. I think that will really catalyze a lot of small investors to finally be able to participate in the market.
All right. Thank you. Let's move on to the next question.
Thanks again for the comment. We really appreciate it. We've been working hard. I mean, if you've been with DragonFi since we launched last year, you've seen that we've launched one innovation after another, and we're not going to stop.
Yeah. All right. So what is a good interest coverage ratio?
So this is again falls into, it depends. Again, depends on the industry. So I've seen industries wherein, for example, I think that was Meralco, right, Franco? It had a very high interest coverage ratio.
Yeah.
And it started deteriorating because it was actually putting on more and more debt. Okay, let me explain this, because this might be a little bit complicated. I remember a situation where in Meralco, if I'm not mistaken, the interest coverage ratio was around 13, double digits, for 13, 15. Then it started deteriorating over time, and it was around still in the high single digits. But in reality, under the surface, there was actually nothing to worry about, because it just points to the fact that Meralco was actually underutilizing its debt capacity. So debt capacity means the ability of a particular company to handle more and more debt. So Meralco was actually underutilizing its debt capacity. So even though its interest coverage ratio was declining rapidly, it was actually fine. It was just securing more debt, because at that point in time, Meralco was really expanding its distribution capacity, and it was going into actually generating electricity itself.
All right, cool. Let's go to the next question. Is it complicated to switch from one broker to another? I'm using a different online platform right now. I'm considering to switch to DragonFi, clueless on how to go about it.
No, it's actually easy. We've had a lot of switchers. So typically, you just sign a form with your current broker to transfer. First of all, you have to open a DragonFi account, because there's this cardinal rule in the Philippine Stock Exchange wherein there should not be a change in beneficial ownership. So you have to open an account in DragonFi with the same account title as your current brokerage account, whether in a different brokerage. Then you just sign the form, you send it to them, and that's easily done within less than 3 to 5 days.
Yeah, you would have to contact their support, ask for the form, and then sign it and then submit it. And you should also be aware that to transfer stock, it will cost 75 pesos from your current online platform, and another 75 from DragonFi, for a total fee of 150. But that we waive the fee above a certain amount, and I think it's any position above 50,000, the fee is waived. So you'd only have to pay 75 to your current online broker.
Yeah. By the way, that's 75 per issue. Let's say, for example, you have a million shares of Meralco. It will still take like 75 pesos.
Yeah.
Yeah.
All right, let's go to the next question. Are you going to send us buy alerts?
Yep. So I'll show you guys. It's here again. So if you go to our app, so if you go to the investing club, I'll show you. So my internet is not that great. So if you go to the investing club, if you swipe up, you can see where home. Sorry, it's in the home page. So if you go to the investing club, you swipe up, you'll see there the Viber, and you can just click the Viber and WhatsApp channel. And before we even buy or sell anything, we post it in the Viber group and the WhatsApp group. Then later on, because sometimes it demands speed, right? Let's say we have to execute right now. Then later on, we actually do post it on the website and send it via email to everyone. So yes, you will receive buy and sell alerts.
All right, cool. Let's have the next question, please. How much would be the most optimal amount to invest in stocks?
This is again falls in the category of it depends on what you in your current financial position. But don't be pressured to invest a lot right away. The important thing is you have to get started early and often. That's what I keep on espousing, because again, let's say if you have a 20-year window, then, or if you have a 40-year window, the power of compounding really can really work in your favor. That's why I encourage all young people to start investing as early as possible. It's the best thing that I ever did for myself. I don't know if people know my story. Really, I came from I didn't come from a wealthy family. I didn't inherit anything, but investing actually made everything possible for me. So this year will be my 23rd straight year of profitability in the financial markets. And the power of compounding has been unreal to me. I wouldn't be here. I wouldn't be here talking in front of all of you if it weren't for investing. And investing really is, if there's one thing that you want to really focus on, it's really investing. Because we took out one slide because we didn't want it to be too long. We had a slide there, the difference that 1% makes. Imagine the difference between, let's say, if you compound your investment at 10% per annum over 20 years versus if you compound your investment at 11% per annum, you actually end up with 20% more. Imagine if you add another percent and another percent and another percent. So really, it really pays to become a better and better investor. As I always tell, so we give seminars to a lot of college kids in the different schools. And I always tell them the three things that you have to do. One of them is really invest early and often. When I graduated in Ateneo in 1999, this is the story that I always say, that the surrounding areas within the Katipunan area, the land was selling around 13,000 pesos per square meter. Now the land is selling around 200 to 250,000 per square meter, but the starting salary has only increased by 2 to 2.5x since the time I graduated in 1999. So imagine, if you really want to have financial independence and you really have to explode. And the only really way to explode is through time. You don't want, okay, obviously we all want to explode as quickly as possible, but leverage the power of compounding. Go on TikTok, type Warren Buffett and about the power of compounding, and he would tell you in that clip, he does cite that the reason he's successful in his life is on account of three things: being born in America, lucky genes, and the power of compounding. The power of compounding is really unrivaled, because it really, if you're counting on your salary, if you're counting on your salary, if you're counting on, let's say, your business income, unless it's a super outlier one, it's a super outlier job, a super outlier a corporation that you were able to start, the growth is really linear, right? It's linear, very linear. But if you look at charts of compounding, you can really slope upwards, like you can really slope upwards like a hockey stick. So it's very different. So that's why it doesn't matter how much you invest, but you should start investing as early as you can.
All right. Thank you, Sir John.
You're welcome.
Let's have the next question.
Sorry for the long-winded answers.
For REITs, they are legally required to pay out 90% of their earnings as dividends. What payout ratio is considered a red flag for REITs? Or is this not a concern for REITs? I think I saw one with a payout ratio of 2,000%.
This is a brilliant question. Franco can answer this, right, Franco?
Yeah. So yes, it is a red flag if any company pays out 2,000%. Because one, the only way for them to do that is if they fund their dividend distribution through debts. That's one way, and that's not a great way to do it. For REIT specifically, it's possible for a REIT to pay more than 100% of their distributable income. Like, for example, C-REIT, if you look at their investor presentation, it pays out, I think, 105% per quarter. But that is only because their AFFO, or adjusted fund from operation, is actually the true amount of how much cash they can distribute. So, because, for example, distributable income is used because it was standardized by the REIT law. But globally, a lot of REITs use AFFO, or adjusted funds from operation, to determine the distribution of dividends, because it was created specifically for REITs to determine the accurate amount of dividends that it can pay out. So that's one reason why a C-REIT can pay more than 100%. But normally, here in the Philippines, you would mostly see that most REITs would have at least a payout ratio of 90%, some with 95%. If it goes below 90%, they will most likely face some regulatory concerns. But if it's above 100% and it's funded through something else, not through earnings, then it is a red flag. So if you want to find out more about it, you would have to look at their annual reports or quarterly reports to figure out whether or not that those dividends did come from their rental income.
Yep, Franco is absolutely spot on. So if you look at the REITs in the US, they are required to divulge what is known as AFFO. So AFFO is actually the REIT version of free cash flow. They add back non-cash expenses such as depreciation. So this is the reason why AFFO can actually exceed income, especially for what I'm seeing in the Philippines, wherein it's usually a property for share swap, right? It's a property for share swap of an existing property that potentially could be fully depreciated. Thereby, there's no longer any depreciation on the books. If there's no longer added depreciation, then AFFO will be equal to income. So in those cases, yeah. So that Franco is spot on.
All right, thank you, Sir John.
Yep.
Let's move on to the next question. You guys are the best. I've been with other stockbrokers and grew tired of their platforms. Do they even have an app like this? This is the future of trading and investing, in my honest opinion.
Wow. Thank you, sir.
Thank you. Yeah.
Thank you. No, it's gratifying. If you can see how fast and how hard we actually move, it's a never-ending cycle, and we feel gratified by your opinion.
Thank you so much for that comment. All right, let's go to the last few questions. Is it possible to create an account for a minor so that I can educate my child in investing? If yes, how and what is the requirements? Thank you for answering.
Again, another brilliant question. You guys are reading my mind. As a matter of fact, we're gonna have a joint webinar with the PSE specifically on this topic. If you open a DragonFi account, in the account opening process, it will ask you if you want to open an Entrust for account, so an ITF account. So an ITF account allows you to open an account for your minor dependent, and at the age of 18, you can transfer you can transfer the assets to the miner by just emailing us, and it happens on a tax-free basis. This is a great question.
All right, thank you. Let's move on to the last three questions. Is there a S&P 500 equivalent in the Philippines?
S&P 500, meaning a way to invest in the S&P 500?
I believe that's one way, yeah.
Okay. I spoke with PSC management. I don't know if I'm okay to divulge
Oh
this,
no.
but that's in the works. Yeah.
Yeah, all right. Okay, next question. Can we now use the pair account to buy stocks using dividend strategy approach?
Yes, wait for that. Wait for that.
Yeah.
We're almost there. We're going to become the first broker to be designated as a pair administrator. So please wait for that. We're very excited about it. We're very excited for dividend investors, because if under a pair account, your dividends grow tax-free. At the same time, imagine what the picture that I showed earlier, wherein you're just growing and growing the dividend stream, and then at the end of it all, you can bequeath it. So your son, your daughter, the next generation can inherit it tax-free.
All right. Yeah, I'm looking forward to that too as well.
Yes,
So, yeah.
this one is great.
All right, let's have our very last question for tonight. As a dividend investor, what can you suggest to do on my portfolio in cases like geopolitical risk? I guess this is referring to the tension in the West Philippine Sea.
Okay. This is I've seen so many cases. Okay, right. So in my US investing, there's been so many cases of geopolitical crisis, or flashpoints, as they call it. But granted, the US has never been directly involved. I mean, the US as a country, outside of September 11, it was amazing. Actually, I was at work because I was a proprietary trader for the US markets, and I actually saw the two planes hit the World Trade Center. So that was the first time that I saw that the US homeland was actually directly involved, but there was no war that took place inside the US. So in every geopolitical crisis, usually it disrupts the prevailing trend. But usually after a while, the trend that was in place before that took place, whatever that crisis was, it actually just went the market went along with its business, without even, as if that particular event did not occur. So I've actually even experienced Brexit, after a brief moment of turmoil, then it was just actually a 1-day gap down, then the following day it was already back up. So that's my opinion about geopolitical crisis. But of course, I'm no expert. If the war does, obviously if the war happens in the Philippines, that's, all bets are off, and I hope we never see that day. But I believe what the US is doing, the US and its allies are doing with Ukraine, is actually to show China the high cost of war. And if nobody knows, but if you were China, if you saw what happened, what's happening in Ukraine, wherein a militarily superior country in Russia is even having a difficult time with something that's just being supported from the outside, a proxy battle. Why would China risk conflict with the Philippines when their main target is actually Taiwan? That is just my opinion. Because the cost of war is just too high. Why would they expend military, economic, and political resources to go after a country that's not their main target? Wouldn't they just consolidate all of this and just focus on the target that they've had in mind through the decades? That's just my opinion again.
All right. Thank you, Sir John, for that opinion. So that is our last question. If you have any more questions, please email us at investingclub@dragonfi.ph, and we'll do our best to get back to you as soon as possible. And for those who have not downloaded their app yet, we are encouraging everyone to download the DragonFi 2.0 app, available on the App Store and Google Play. Access all Investing Club content at your fingertips anytime and anywhere. Follow us on our social media at DragonFi HQ. And this concludes our webinar for tonight. Thank you so much for joining, and we hope you learned something from us. Thank you.
Yeah, thank you so much. I really enjoyed all the questions. I appreciate the fact that you guys are so into investing. It's really, as I mentioned, the one endeavor that you want to focus in. Thank you so much.
Bye, everyone.